right. Good evening, everyone. Thank you for joining us this evening for Market Spotlight with ARK. So, does investing in innovation still make sense? So, by way of introduction, I'm your moderator for this evening. My name is Hayden. I'm a senior wealth advisor here at Syfe. Our speaker, Ritesh, head of investment advisory, and also our guest speaker, Renato, who is a portfolio specialist with ARK Investment Management. So this evening, our agenda here, we'll be talking about the state of markets, rise and fall of investing in innovation and growth. We'll be having a fireside chat with Ritesh and Renato. And of course, we'll be taking some Q&A from here. So over to you, Ritesh.
Hey, Hayden, thanks so much for the introductions. I'm very, very excited to have ARK join in today with us. I think it's very, very topical too. And of course, given where the markets are, this is a quick poll that if everyone can join in and weigh in as well in terms of like what is top on mind for you when it comes to the markets. So inflation, rate hikes, recessionary fears, and risks. All right, let's look at the data. Awesome. All right. Yeah. So, I mean, obviously, inflation and rate hikes are things that we are already observing. But the bigger, I guess, concern for everyone right now is, are we headed into a recession? So if you think about what's top on mind for everyone around us, it's basically inflationary pressures, rate hikes, which basically mean that are we getting into an environment where there will be low growth and heightened inflation. There is also concern about the stagflationary environment. Are we going back to the 1970s? Is this similar to a dot-com bust? The equity bear markets are here. Where do we go from here to the near future? And of course, the bigger question of the future of innovation and innovative investing as well. So these are, of course, top on mind for all the investors. If you look at the state of the markets on the next slide, what you'll observe is so number one, the rise, which is basically the post-pandemic rise that every one of us were witness to, fueled a lot by quantitative easing, a lot of like easy monetary policies to kind of fight through the COVID pandemic. And as you can see, we did have a drop somewhere in March 2020, but the markets rallied massively as more liquidity was pumped into the economies, especially I think in the growth segments led by ETFs such as ARK Innovation. Some of these rose by more than 100% during the post-pandemic rally and continue to do so until 2021. And coming forward into 2022, if you move ahead, what you observe is a little bit of a divergence emerging where the broader market has corrected. So Dow Jones, down 14%. But more importantly, S&P 500 entered into the bear market. NASDAQ down close to 30%. And more importantly, the more innovation-based and disruptive technology-based investments falling through by 50% or more as well. If you look on to the next slide, there is also some sort of a divergence between growth versus value. So the Russell 1000 index also down, but if you compare that with growth index, and you can go into the large, medium, and small cap aspects of it as well, but largely there is a divergence between how the value-based investing world has performed versus high growth investing. If you take it further, I think the next slide is very interesting, which talks about the broader market. And if you consider NASDAQ as the blue chip tech investing index, there is this other index called the GS non-profitable tech basket, which has fallen by more than 50%, right? So there is also on one side, divergence between value versus growth, but even within growth, there is a divergence between profitable growth companies versus non-profitable growth companies. And this is something that we will talk more as we explore these sections a bit deeper with Ren. So if we move on to the next slide, I will want to hand over a bit to Ren and get him to introduce himself. Introduce ARK. That I'm sure a lot of people know about ARK, but maybe they don't really understand the overall investment philosophy. So it'll be great to understand how you guys think about innovation investing and disruptive technology as a whole, and also maybe a little bit of a recap of what I talked about, but give a little bit more context on how did we even get here, right? And how do investors think about the markets going forward?
Yes, absolutely. Thank you, Ritesh. And thank you for the introduction, Hayden. As you mentioned, my name is Ren Leggi. I'm a client portfolio manager at ARK Invest. I've been with the firm since 2018, have been following them since almost inception and back in 2014, and have been working alongside Cathie Wood and the investment team since then. So it's been very exciting. For those less familiar with ARK Invest, we are a very unique kind of financial and asset management firm in the sense that, Cathie founded the firm to really move away from kind of traditional conventional thinking in this space. And we're focused solely on investing in disruptive innovation, specifically in the public equity markets, but we're starting to see opportunities elsewhere. But we're also trying to democratize finance, very similar to Syfe in that sense, where we're open sourcing all of our research and putting out there free of charge. And people are kind of surprised by this. And it's interesting, right, that we're sharing all of our information and it's actually improving the work and the quality of the work and research that we do. So we've structured our team, our research team, not by sectors like traditional Wall Street firms, but by technology. And that's because we're in a very unique time period in technological history, the likes of which we have not seen in over a century. And that's because we have identified 5 innovation platforms evolving at the same time. So DNA sequencing, energy storage, robotics, artificial intelligence, and blockchain technology. All 5 of these platforms not only are happening at once, but now they're starting to converge, that are going to, in our view, create exponential growth opportunities over the next 5 to 10 years. And we haven't seen this much innovation happening at one time. You would have to go back to the late 1800s to see this much innovation happening. That's when you had electricity, you had the automobile, and you had the telephone. And that created about a 50-year period up until the roaring 1920s. Where the economy grew significantly and the world changed as we knew it. I mean, the last big change we've gone through was in the 90s, and now we're being compared to that. The internet, the internet was the last big innovation platform that created roughly, by our estimates, about $10 trillion worth of business value and wealth creation over the last 20 years. And now we're on the brink of seeing these 5 platforms growing, and our estimates are that they will create over $200 trillion worth of business value and wealth creation by 2030. And I think what's interesting, and maybe you shared those 3 risks up there, maybe the 4th should be the fact that many investors don't even have exposure to these innovation platforms. And we think that is probably the bigger risk going into 2022 and into 2023 and beyond. And I'll get back to that. But so we focus our research by technology. Each of our analysts have a specialty in the underlying technologies, and they're working together because of this convergence. So one of the things we've seen just over the last few years, genomics analysts now working much closer with our artificial intelligence analysts, because in genomics, you think about our DNA, 3 billion lines of code, right? We need to process that information, make sense of that. And artificial intelligence and breakthroughs in deep learning is allowing us to do that more efficiently and at a lower cost. And so our analysts are working together, understanding these technologies. And so we typically come to a conclusion that's much different than traditional thinking or traditional Wall Street. And so our estimates could seem, crazy, but we do the fundamental analysis from a top-down technology perspective, looking at cost declines associated with these technologies that are going to lead to exponential growth in demand for these technologies as they become cheaper. And they're solving a lot of the problems that we're faced with. So in terms of the market cap, the market recap, right? If you look at 2020, why were we so successful in 2020? Well, the 5 innovation platforms, and we break them down even further into 14 kind of transformational technologies. Every single one of those technologies actually accelerated their adoption rates because they were serving as solutions to many of the problems that we were faced with during the pandemic. Genomics is probably the prime example. I mean, without DNA sequencing, we would not be able to actually understand the coronavirus. And we were able to sequence it in a matter of days versus other viruses like SARS, 20 years ago, where it took 5 or 6 months to sequence and truly understand it. From then on, it took, I think, 42 days to create a vaccine. And then with artificial intelligence, we were able to accelerate the approval process and roll that out. So genomics was a direct beneficiary. And that was one of the top performing themes in 2020, because this technology was extremely useful in getting us out of this scenario. And as people were turning to other technologies like digital wallets, right? Because they couldn't go to their bank, they were shut down, and the branches were closing. You have, people were starting to use robotics and automation because they wanted to eliminate or limit the human interaction and spreading of COVID. So all of these technologies accelerated. Essentially, we saw a doubling in the market cap. They went from $7 trillion by the end of 2019 to just 1 year later, by the end of 2020, they doubled in market cap to 14 trillion. Now in 2021, there was a tipping point where the market started to broaden out, which we saw was a positive signal, because there was a rotation away from growth and into value. And that we were seeing both growth and value start to perform well. And that is a good signal in a bull market. Now, there was a tipping point towards the kind of the end or middle to end of 2021, where this fear of inflation, rising interest rates, put a lot of uncertainty in the market. And I think that's what caused a lot of investors to become very risk adverse. And any high growth, any risky or volatile type assets were essentially disproportionately punished and sold off. And I think that's how we've gotten to where we are today with this drawdown that has lasted now 16 months. Now, there's been some macroeconomic events that have happened that, I don't think anyone foresaw. Certainly the Russia invasion of Ukraine has had a very big impact on supply chain strains and inflation, which has now led to increased interest rates, right? The fact that oil prices rose so quickly. I mean, they haven't rose as much as everyone was expecting. I mean, people were calling for $200, $300 a barrel, and we see that that's not the case. And we think that's because oil demand has already peaked, and that this shift that's underway, which we were very focused on and have been focused on since the beginning, away from gas-powered vehicles to electric vehicles, has helped accelerate that adoption. So we're still seeing kind of fear, uncertainty around inflation. But I think what's important to note is that innovation solves problems. And and we're seeing signs, and we can talk a little more about this, where we're seeing signs that the bigger risk might actually be deflation, because there are cyclical aspects. The fact that inventories are starting to build up. We're seeing Walmart, Target, these are major US retailers reporting 30-40% increases year over year in inventories, meaning that these companies are going to have to unload these inventories at a much lower price. So that's going to put downward pressure on prices. We're starting to see that in the auto market as well. That makes up roughly 20% of the GDP. So we could start to see used auto prices, especially the gas-powered vehicles, dropping dramatically. And that will help kind of put this deflationary pressure. We've already seen a lot of commodities peak in terms of pricing. Many are trading, half of what they were, just 6 months or a year ago. And so this, we think, will continue to put that deflationary pressure. These technologies making goods and services cheaper is also a longer term kind of deflationary trend. So this is setting ourselves up for what we think will be a very strong market going into 2023 and beyond. Our view is a minimum 5 years. So we're not looking at what's going to happen in the next month or two, right? It's very difficult to forecast the markets, interest rates, and that's not what we claim to do, right? We forecast technology cost curve declines, which in fact, using some of the tools that we use, is actually quite predictable. We've been almost spot on our EV forecast from 2017 that we put out, which which we sold, 4.8 million EVs were sold in last year. We were forecasting roughly 5 million. So, and that's because of the cost decline associated with that technology and the fact that people were starting to see these prices drop and shift away from gas powered to EVs. And so that's what we're looking for. And we've been able to forecast these technologies with higher degree of accuracy than the financial market. So we've stuck to our process throughout this period where we're focused on innovation. We're looking to uncover these leading edge companies that are going to provide exposure to these 5 innovation platforms. They're either key enablers or key beneficiaries that we expect to see kind of exponential growth opportunities going forward.
Some great perspectives, Ren. Thanks for covering that. And I mean, I would heavily vouch for what you kind of alluded to initially in terms of like accelerated adoption. And I would have to say we were fortunate enough to be part of that accelerated adoption as well, where we saw a lot of clients and investors who were previously skeptical about digital investment and wealth management platforms, with more education and the fact that they were sitting in their houses and sorting out their finances and they didn't have anyone to go to, came to our platforms, realized the value that we can provide, and led to kind of that exponential growth that you talked about as well. Now, in terms of what you also put forward as a view going forward, the deflationary trend is a very interesting perspectives that you bring onto the table as well, because on one side, the broader consensus is about high inflation and hyperinflation, whereas what you mentioned more on the innovation side and disruptive technology side, there is actually a more deflationary trend, and even broadly there is that deflationary trend that you're talking about. Now, putting that into perspective, but also thinking a little bit from the investor hat, because the market sentiment has actually still shifted away from growth investing pretty prominently, right? And while ARK has been a big proponent of disruptive technology, is that thesis still makes sense? How should investors think about investing into these sections of the market, given the kind of drawdowns that they've seen in their portfolios?
Yes, I mean, so what we've seen, having an allocation to innovation, we think is very important, right? I mentioned the size of this opportunity, and there's a lot of growth potential in investing in these technologies, but there's also another risk. There's the other side of that, right? As investors have flooded into more defensive stocks, more value-oriented stocks, and back to their benchmarks. So going back to the S&P 500, going back to the NASDAQ, in terms of safety, maybe not so much NASDAQ, but maybe Dow Jones or MSCI World, right? When we look at those indices, we look at those companies that make them up, and we're seeing a lot of risk in terms of these companies becoming more and more vulnerable to disruption, right? You pull out traditional auto manufacturers, right? Because of companies like Tesla that are essentially upending them in the sense that they're, essentially shrinking the gas-powered market, which that's what these companies have done for the last 100 years, like a Ford. And they weren't prepared for this shift to EVs. They thought it was just going to be a niche product, and that it would only be a subgroup of people that wanted to feel good about the environment. And now, because of that cost decline, it's made it more affordable. I mean, already the cost of ownership of an EV is much lower than a gas-powered. And if gas prices, I mean, if we're wrong about, we think gas is going down or oil going down, but even if we're wrong about that and it continues to rise, that we would directly benefit, because people will continue to shift away from gas powers. When they rethink about buying a new car, we've already seen acceleration in EVs. So these opportunities are also kind of disrupting these other industries. I mean, you all are disrupting the banks, right? The shift from from traditional banking to digital wallets. We've seen this in countries like China. It can be very impactful. We're seeing these trends in the US, we're seeing them in Singapore, throughout Asia, other parts of the world. And so that is disrupting a big segment, the financial services. Blockchain technology is disrupting, taking the friction out of the financial markets, which has been an industry, frankly, very ripe for disruption, right? And even genomics. gene editing, sequencing, diagnostics. That is all starting to disrupt big pharma. So there's a lot, and these companies make a very large weight of those broad-based indices. I mean, you think about the investors. I think it's the last estimate I've seen was, investors have about 12 to 13 trillion dollars tied to the S&P 500, and we think roughly half of those companies could be disrupted over the next 5 years. So, do you want to continue to have all of your eggs in one basket, or do you want to have, if we're right, if we're even remotely right on how big these opportunities are going to be, do I want to have at least 5, 10% maybe of my portfolio geared towards these innovation platforms? And frankly, right now, and we will talk about this hopefully later on, the valuation side, this is a very attractive entry point for those that don't have it or are looking to build their allocation. Some of these companies are trading at valuations that we haven't seen since pre-pandemic levels, or even in some companies are trading below the bottom of the coronavirus, March of 2020. So yet they're fundamentally much stronger. We've seen significant revenue growth, which we think will continue, maybe not at triple digits, but still in a scarce growth environment. For those that are, I think it was 80% worried about recession and risk, well, these are companies that we think will continue to grow revenue even during this slowdown, economic slowdown, because they're going to solve a lot of those problems caused by recession, and they're providing goods much cheaper, more efficiently, and faster. And so they're starting to gain even more market share during a downturn. So they're going to become, we think and we've been through these periods before where they come out stronger on the other side, but the market just so focused on short-term risk just completely buckets them into one big category, and just sells them all off. And so there's a lot of pockets in there, especially in innovation, right, where we can find, and we're an active manager, so we can find those companies that have been hurt, but that we think are going to continue to grow and come out stronger on the other side.
Awesome. Thanks for the perspective, Ren. We will skip the next question, but let's move on to the following, because you addressed the aspect of growth versus value investing already. Let's look a little bit deeper within the high growth segments. And what we also do observe is, let's take this poll first. So what percentage of, and I think you alluded to this part as well, like how much percentage of your portfolio should be in growth investing, right? So let's take a poll and see how people are actually investing first. So if everyone on the webinar, if you could see this, what percentage of your portfolio exposure is growth oriented? Is it less than 20%, 20 to 40%, 40 to 60%, or above that, right? So let's take a quick 5 seconds. Vivian, if you could see the results. Wow, all right. Looks like there are a certain section of folks who are very, very excited about growth. So, what do you think, Ren, right? I think it gives me the feel that people are actually much more loaded in growth investing than what you had suggested, or in general, the positivity in the growth investing is still very, very, there to see. Though I think the follow-on question will be for all of these clients, they would have seen the rise, they would have also seen the current fall. So how do they position themselves going forward? But this is a very interesting stat to see a lot of people, much better invested into growth-oriented assets, and kind of subscribe to all the things that you mentioned as well.
Yeah. So back to kind of this question, right? Unprofitable tech, and I think that is certainly a category that the market has attacked quite a bit, and put any company that has unprofitable in that category, and it's sold off. Now, the way we look at it, unprofitable tech or unprofitable innovation companies, because that's really what we're focused on here, is not negative. It's because many of these companies are unprofitable because they choose to be unprofitable, because they're spending very strategically, and in some cases aggressively, in R&D, on capital expenditures, or maybe even making kind of smaller strategic acquisitions to put them in a competitive advantage and put them in a place to take advantage of a total addressable market that is people are underestimating the size, right? I mean, Tesla is a perfect example. It is a top holding, so I will fully disclose that, right? But, they were going after the EV market, right? And people thought that was a really small opportunity, but they knew that this was going to be a very large opportunity. So they were investing very aggressively, and they weren't profitable. They were a multi-trillion-dollar company before they became profitable, and then eventually added to the S&P 500 index. But a lot of investors missed out on that upside because they kept, pointing out, oh, it's unprofitable, it'll never succeed. Meanwhile, they were just spending very heavily on R&D. They were building gigafactories. They continue to do that. And so it's okay if our companies are sacrificing those bottom line earnings to be more competitive for that longer term growth. So a lot of our companies were attacked because they had high price to earnings multiples. But in fact, when we do our modeling work, we assume, and because we're doing it over a 5-year period, we assume that that multiple will compress over time to kind of industry standards. So we don't cheat in terms of expanding the multiples on our companies. And so that, because we're seeing that these companies are going after a total addressable market that could be 5-10 times higher than what people are expecting. And, we're looking at their top line revenue growth, right? And how that will look 5 years from today. So we're looking at a company and saying, well, what will this company look like 5 years from today? And then we can discount the future cash flows back to get to what we think that company should be worth 5 years from today, right? Investors have been so focused on the rising interest rates. And yes, technically, when you're looking at long duration assets, a higher interest rate requires you to increase your discount rate, which overall reduces your longer term, or maybe in most cases, your 1 year or 2 year price target. But what we've seen is, and kind of the second part of this question, right? Capital and scarcity and costly, right? Yes, as interest rates rise, the cost to borrow debt is much higher. However, a lot of our companies, especially in the genomic space, that have higher cash burn rates, they raised a lot of capital in 2020. And they've flushed their balance sheets with a lot of cash. And we just conducted analysis on our flagship strategy, the ARK Disruptive Innovation Strategy. And if you look at our companies, many are unprofitable, but many are free cash flow positive, meaning they can continue their operations, based on the 12 months, trailing 12 months of free cash flow. And in fact, those that are not positive have positive free cash flow. They have at least, except for one company, all companies have at least 9 quarters worth of cash, so almost over 2 years worth of cash to cover their cash burn. And so that makes them, fundamentally very sound. And so they could dial up the R&D or they could dial back the R&D if we get into a tough environment. But the fact that they have that much cash to continue, stay competitive, but the market doesn't look at that, right? They just say, hey, these are risky companies, sell them off. When we feel better about the economy, we'll look at them again. But these companies are gaining market share. They're becoming more attractive from a valuation standpoint, and they're setting themselves up for kind of an asymmetric upside opportunity once the market shifts back into favor for growth. So we're not worried. We keep our focus on a 5 years. In many cases, this creates opportunities for us. We take a contrarian approach. We've been consolidating into our highest conviction. So if you look at the portfolio, I mentioned kind of the flagship portfolio. We went from 57 holdings down to 33 holdings over the last year to 14 months. And that's because we're consolidating into our highest conviction names. Many of them have been disproportionately punished. So we've been able to average down in those positions. And many of our clients do the same with our funds and strategies. They'll average down in these environments. And what we've seen is in the subsequent risk on periods, that's where our companies start to shine through and the market realizes that growth potential and then starts to price that in. We want to be there before that happens, right?
Absolutely. And I think very good perspective on averaging down. I think a lot of investors into Syfe as well, they are long-term into this game, and they're investing for their kind of future goals. And these goals tend to be like this 10-year, 20-year down the line. If you're planning for retirement, children's education, stuff like that, I do believe there is a merit for investors to, yes, invest in a diversified manner across asset classes, across geographies, sectors, but also make sure that they don't miss out on the participation, right? So this is where I think these things become very, very important fundamentally. And the parts that you mentioned that reducing risk may be helpful, but if you're not taking risk, then that is even more sort of problematic in the long term, right? So the fact that you guys have narrowed it down from 57 odd names, I last read you were down to 40, but looks like you've gone even more concentrated. And while that is even more risky given the current situation, but you've gone into your more high conviction territories. I think the bigger question that a lot of people have is this a repeat of the .com bubble, or are things different this time around? Because it looks like, yes, the future looks very promising in these areas. But the initial thesis that we had for all of these subsegments and all, do these thesis still hold out? Because as you said, like, you do take that contrarian view and have a much larger addressable market, as you say. So has any of that changed as you have looked at what's happening in the market?
Yeah, so when you compare, a lot of people are, because of the significant drawdown that we've experienced, many people are comparing us to the NASDAQ back in the tech and telecom boom and bust. And as investors, business leaders, entrepreneurs, they were all on to something very big with the internet, right? But it went too far back then. And imagination kind of got out of control. It got the best of investors. And, people are kind of flocking back to that consensus view again. But this time they're hugging the benchmarks and they're holding on to old tech, which is almost kind of the reverse scenario that happened back in the tech and telecom bust. So the key differences between then and now is that the technologies that we're talking about, the 5 innovation platforms that I mentioned earlier, are ready for prime time. These seeds were just planted back in the early 2000s for these technologies. They weren't ready to be investable, but fast forward 2 decades, now they are. And the second big difference is that the fundamentals of these companies look very different, right? You look at last year, our companies on average grew revenues by more than 60%. When you look at, and even if you look at some of the Bloomberg estimates right now for the next 2 years, consensus is around that these companies on average will grow revenue from to roughly about 25%. We think it's much higher based on our research, but just consensus is forecasting double digit. When you look at what happened to the NASDAQ, say 100 back in 2000 to 2002, the revenue growth decelerated from the low to mid 30% to negative territory before it recovered. And I think it took until 2004, 2005 to recover. That's not what's happening right now. Growth is continuing. It's still very high. It may be slowing down, but it's not turning negative. And I think that is one of the clear differences, because there was just so much, unprofitable tech, but there's just, essentially there's a lot of fraud as well that was happening back then. This is not, we're not seeing at least that with our companies. These are, you look at companies like Tesla, Square, Roku, these companies have significant revenues. They are turning profitable, Zoom, and they're also increasing their gross profitability. They're becoming more profitable over time. So that's a metric that was not the case back in the tech and telecom bust for the NASDAQ 100. So these are very clear signs that this is much different. And I think one of the concerns is, it's going to take 10, 15 years to recover. And we think the recovery would be much shorter because of how strong these fundamentals of these companies are and how we're seeing an acceleration in adoption for these technologies, and the fact that we have 5 platforms, not just one back then.
Very interesting perspectives, Ren. We'll just skip over a couple of slides. I think what will be interesting to also know is what are the current market signals? What are they telling us now? What are the trends and flows? I recently noticed that the ARK had one of its longest streaks of inflows this week. So could you give us a rough breakdown of indicators besides kind of returns on what the market and investor sentiment is right now? And if there are pockets of growth, opportunities, new ETF launches, what are you guys thinking?
Oh, yes. So from a product standpoint. So in terms of flows, yes, it's been pretty amazing. The loyalty and conviction that our clients have across the globe, right? And we have a mix of institutional investors, high net worth, retail investors, and all have been very positive, even in this down market. So in 2021, we saw gross inflows of 21 billion as a firm. By the end of the year, we kept 17 out of that 21, right? And so we lost only 4 billion, which may sound like a lot, but it was a lot of the investors that were performance chasing, right? They were just watching the performance and they just had to jump on the bandwagon, but they didn't really understand what we do and how we do it, and that this is a long-term investment. And when things got tough, last year, towards the end of the year and into this year, they needed out. The volatility was too much for them to stomach. And, I want to warn those, in the audience, this can be a very volatile period, and technology innovation can be volatile, but we don't think volatility is a bad word. It actually can be very positive, especially when the market is going up. Right, there's going to be a divergence between the old world and the new world, and that will just naturally create more volatile environments. But that's not necessarily a bad thing, because when you look at the underlying technologies, they are moving in different directions. So, for instance, what's happening in DNA sequencing companies is not going to impact what's happening in these blockchain technologies. Right now, the correlations are close to one, because they're just higher risk, higher volatile assets. But they are moving in different directions. So we get a lot of comfort around investing across these technologies and putting a portfolio together that has exposure to all of these technologies that are moving in different directions, right? So we actually, even the consolidation, because we have higher conviction in those names, yes, it could be a little bit more volatile, but longer term, we think we have a portfolio that is very diversified from a technology and company perspective that can help produce returns going forward. But we're seeing so far year to date, and this data is coming through just a few days ago. As a firm, we're still net positive inflows in our ETF suite, which is the bulk, roughly half of our assets. That is positive by several hundred million. And our flagship strategy, the ARK Innovation strategy, is actually up year to date in terms of net flows, 1.6 billion. So we're seeing that. I would say, given that I talk to our investors, large to small, around the world, many are starting to get very excited about this opportunity because they're seeing the valuations. I mean, we have even deep value clients that are saying, I'm starting to buy some of your stocks because they're becoming value stocks. The fact that Zoom became part of the Russell 1000 value index is pretty shocking and crazy. I mean, that doesn't really happen for us. But that's a signal where, these companies have gotten so cheap that we're starting to see a lot of our clients, for those that, were waiting for a pullback, they've started to average in. For those that may have added a year and a half ago, they really liked us then. I mean, you should really like us now. We're much cheaper. We're on a heavy, and there's a heavy discount sale right now going on. And this is an opportunity, and we're seeing that in the flows. I mean, you highlighted the streak that we've had. Investors see the potential here, and they're long-term investors. And I think that's the key. If you're looking for the next 6 months, this may not be, the right strategy. We don't know. With the macroeconomic environment, we're looking at, in terms of market signals, we're looking at the inventory levels, we're looking at oil prices, we're looking at commodities, we're looking at consumer sentiment. The Michigan index, I mean, it's the lowest it's ever been in history, dating back to 1940s. That is, that's increased our concern about a recession. But, in a recession, like I mentioned earlier, innovation solves those problems and these companies gain traction. So I think our clients are seeing that. And, that's what's led to kind of these flows. But it's also about communication, right? We're one company where even when we're performing very poorly, we're out there even more. We want to explain what's going on in the market, right? Give our investors comfort. Cathie is doing, and she'll be doing it tomorrow. She does in the know videos where she just talks about the macroeconomic environment, what's going on. And she does that. She started it back in the height of the pandemic in 2020. She was doing it weekly. Now she's doing it once a month. But just explaining what's going on. And I think that's helpful for all of us to know and understand. And it's giving our clients, reassurance that we're onto something big, right? There's patience, things are working out. We're seeing signs of positive, light at the end of the tunnel. And we think the Fed and some of those leaders have not been looking at the same data and have maybe kind of, trying to make up for what they should have done maybe a year ago. And so this kind of knee-jerk reaction is creating kind of a shock to the system. But things are starting to look positive, and we could start to see things turn over the next 6 months.
Awesome. I'll just lump together a couple more questions in the interest of time. So, I think this is a very interesting part as well. Like, what is it in your team that you're most excited about? Any select top holdings, conviction ideas, as well as what is the biggest risk that you see to your strategy as well?
Yeah, so in terms of what we're most excited about, I mean, it's hard to pick among all these technologies, right? Because we're excited about all of them. And in fact, we release, so for those of you that haven't looked through this, it's very comprehensive. It's a long deck, but it's pretty, it gives you a good sense of the top-down research that we do. We release every year our Big Ideas report. We've been doing it since 2017. And this year we highlighted 14 technologies that we're most excited about in the coming year. This kind of shows, what the technology is, how it's been gaining traction, and then how big that opportunity could be. And so that's how we got to that. I mentioned that number, $210 trillion opportunity by 2030. We didn't just make that number up. It's a culmination of all the work that we've done at the technology level, and based on our forecasting, how big these opportunities are going to be. And so I think, some of the areas that, artificial intelligence, certainly one that is going to be the most impactful, right? It's the broader one, the broader category. We think of that 210 trillion, about 90 trillion will come from artificial intelligence, deep learning. And I think what's so exciting is just in the last year or 2 years, we've seen significant breakthroughs in artificial intelligence. So some of these breakthroughs we weren't expecting for another 10 years. And that has accelerated the timeline. If you pair that with AI training cost data, the AI training model cost decline, which is dropping 60% year over year, that's allowing companies to be able to use AI. And we think every company will have to use AI to make them more efficient. I mean, you take what could happen is we see, especially in a recession, right? People are laying off employees, but automation and AI can actually improve the productivity of your existing employees. So take a programmer, a developer, right? If we can use automation tools that cost maybe $10,000 a year, and that makes you as productive as 1.5 employees, you're going to gain productivity, right? And these tools and these companies are going to gain traction. So artificial intelligence, I would say, is very exciting. I would just say generally genomics, I mean, has always been very exciting. Fact that how fast these technologies are moving, and you need to have a very technical background to understand them. And we've created that team. Our genomics team is, I think, top notch, coming from top cancer research institutions to top academic institutions, but understanding these technologies that are going to disrupt, the big pharma space. So those, I would say, two. And then the third that, that has become kind of more exciting, the metaverse, blockchain, Web3. I mean, there's been significant breakthroughs in that respect, from virtual reality, augmented reality, now to this kind of virtual world, metaverse. And we think the underlying power and technology is cryptocurrency that allows this decentralized nature will help enable that world, bringing, digital goods, really, shifting away from the physical world to the digital world and tying digital ownership, right? It's when we think of digital asset ownership, that's property rights essentially. And we've seen historically, as you improve property rights in countries, that improves the economic stability and growth of these nations. And we're doing that virtually now. And that decentralized nature allows you to have that digital ownership, but also bring it to various virtual worlds. And I know I sound like a sci-fi movie, but this is happening, and it will happen. I don't know if we'll all be wearing virtual masks. I mean, we had our virtual analyst wear it in one of our meetings. He got sick, I think 15 minutes in. So we're maybe not there yet in terms of the hardware, but we're seeing this happen. In terms of the biggest risk, right? I think one of the biggest risks we see out there that probably keeps us up most at night is the fact that these companies are so cheap that they now could become targets for acquisitions. So I'll give you an example. Invitae is a genomic diagnostic company. We think they're going to be essentially the Amazon of genomic testing and diagnostics. They went from $60 a share to now under $3 a share. So the risk there is that they get acquired at $10 a share, right? And that may seem, we're getting it, we're getting a 4x premium, but that we think is limiting their upside potential, right? So we don't like to see these companies being acquisition targets and being acquired. I mean, Netflix was talking about acquiring Roku. I mean, that is probably the biggest risk. So what we've done is not only talk to these companies that could be targets, but we've looked at the institutional client base, right? And a lot of them are aligned with our views on, like Invitae, good example, where these are like-minded institutional investors that are kind of holding the top positions in that stock and kind of banding together in the sense that if there is a potential takeover, that they need to fend them off and continue to do what they're doing. So we've been aligning ourselves closer with management from that respect to fend off a potential acquisition at a much lower valuation that we think could be the case over the next 3 to 5 years. So that's probably the biggest risk that we're seeing from a macro. If you asked me maybe three months ago, it was more around kind of the Fed's reaction to the inflation and the fact that they were going to. That still is kind of if they continue to increase interest rates, it's not the fact that we'll be at higher interest rates, right? It's more the shock that they're creating. I mean, you think about, they've increased interest rates by 6 times in a very short period. You mentioned comparing back to the 70s and 80s, right? Yes, interest rates were high then. It went from 10% to 20%. That's just doubling. But you look at it from a relative perspective, if we get to 10 times, I mean, that is a serious shock. And so the Fed will have to be forced to kind of unwind that. So it's almost like they're pushing us into a recession and then can potentially cut rates so that they can get us out. So, I mean, I wouldn't say that's something that keeps us up at night, but that's certainly a risk that's looming, that they are a little too aggressive in their approach to kind of counteract some of the things that they didn't do in the past. So, but more so the M&A activity, probably the bigger risk.
Absolutely. Thanks so much, Ren. And I guess, I was also reading that Cathie actually expects the Fed to be more dovish going forward rather than, be more hawkish. So, that hopefully should pan out, and, we shouldn't come into a state where there is this hard landing, if I may say so, right? But, coming back to one of the points that you mentioned about the Web3, metaverse, and related, on the other side, we are, what we call into is like a crypto winter. What are your thoughts on this? There obviously have been, significant volatility in this space over the last few months, with the debacle in the stablecoin world and the likes and all as well. I think the broader and the bigger question is like, how should investors think about investing into these? How can they do it more responsibly and still, participate in the long-term, growth and wealth accumulation with these investments?
Yes. So the good news is we've been through a few crypto winters before, right? And we've been focused on crypto. We made our first investment as a public asset manager into Bitcoin back in 2015. So we were the first. And from there, we built a crypto team, crypto blockchain team, which was very early, and we have a very good understanding of that market. We have some of the top talent and some of the top, thought leaders in that space. So, from our perspective, we've been through this period before. It's good to see it. It kind of shakes out some of the noise. And I think that the Terra and Luna blowups in the stable coin world, now Celsius and Three Arrows, this is somewhat kind of positive in the sense that it gets people to kind of reset. And with that comes some regulation, right? But, that could also be kind of, if we're seeing more stringent regulation in the crypto in general, and certainly in the stablecoin in particular, we think that this will make the kind of more secure, more conservative blockchains like Bitcoin and Ethereum. It will allow them to continue to gain market share in the crypto market ecosystem. And those are the two that we've been primarily focused on, over the last several years. I mean, Bitcoin since 2015, Ethereum since we started getting much more bullish in 2020 as we were seeing the platform and ecosystem really build out and also enabling decentralized finance and now kind of this metaverse theme. So regulation, we think, short term can hurt the market, right? And kind of that's why we're in this kind of crypto winter. But I think it will come out positive on the other end. Bitcoin, Ethereum will gain traction. And so our view of this market has only increased. One of the things we recently published, and we're going to continue to do this on a monthly basis, is we have a Bitcoin monthly report. And so it provides a bunch of signals in the market. So we're looking at, macro signals, we're looking at, the market sentiment, we're looking at some of the underlying network health of the cryptocurrency. So, the on-chain activity, and we're seeing that many of these factors are still signaling bullish, some neutral, a few, mainly the macro being bearish, but longer term, we have a very positive outlook for Bitcoin and some parts of the altcoin market, right? We think a lot of these, likely are going to zero, but the market share will accrue to kind of a small group of winners in kind of each of these areas, separating out, Bitcoin as more of a store of value, kind of a replacement for, say, a gold. We call it neo gold. That's just one use case, right? But Ethereum being more kind of the decentralized finance, kind of going into the Web3, kind of the next layer of the internet. So all of that is summarized in our Big Ideas 2020 report. So we have a number of sections. We have a Bitcoin section, blockchain, public blockchain. We have a decentralized finance and Web3 section. So you can kind of, in the interest of time, you can go through that deck and you'll see a lot of our views on how big that market could be, or each of those markets.
Awesome, that's great, Ren. Thank you so much. Let's take a quick poll now and see what people joined in are most interested with respect to innovation investing. So different areas, artificial intelligence, and some of these are areas that, Ren, you mentioned as well, fintech, robotics, cybersecurity, and you can choose multiple. So let's see, which areas are people most excited about. And maybe after this, Ren, I know 3 minutes left. Aidan, if I do see a couple of questions on the Q&A side as well, So maybe just wrap them into one, and we get views from Ren on them, and then we can kind of summarize. I think fairly distributed, though AI, cybersecurity standing out, but also everything else, I think roughly similar. So yeah, I think equal, I would say, interest in all these areas. And I would also love to see how each one of these segments evolve over time, and how can we best get those exposures as well. Of course, with ARK, there are all these sub-segment investings that we can do, but also the flagship fund through which we can invest as a whole too. So very, very interesting. Hayden, if you could quickly bring in a couple of, I think, very specific questions that we have on a couple of stocks. Maybe we get a quick view from Ren, and then would love to see some summary of what the future of investing holds for every investor out there, and what does it mean for us going forward?
Right. Thanks, Ritesh. I think we've been seeing this question coming quite a bit over tonight's session. So Ren, for ARK, how do you guys actually view Palantir and Zoom, of which I've mentioned a few times during our session today? Are they considered very high growth companies in your view?
Yeah, so I'll start with Palantir. That's a company we have owned in the past. We don't currently own it. And the reason for that is not that we don't think it's a innovative, growth-oriented company, but it started with some around the valuation, right? So our valuation hurdle is 15% annualized over a 5-year period. So when we invest in a company, we hope for it to achieve at least in excess of that 15%. Now, most companies in our portfolio, given the drawdown that we experience, are well above that in terms of our expectation over the next 5 years. So we're starting to, this was kind of middle of last year, we're starting to reduce that exposure. So it was sitting towards the bottom of the portfolio. And I think the main reason why we eventually exited was just consolidation into our higher conviction names. As I mentioned earlier, went from 57 to 33. And so where we had a little lower conviction, Palantir, more around the competition, certainly on the government side, which is a big focus of their business. There were signs that they could start to see slowed growth. And so we had other companies in the portfolio, like a Zoom, that we had higher conviction in. And so we consolidated into those companies. So Zoom is certainly one that sits at the top of our portfolio, and we think is, a very misunderstood company, right? People kind of grouped it in as a stay-at-home stock. More than 2 years later, we're all still on Zoom. This is, we're evolving into this hybrid world, and we're seeing an increase in enterprise usage. So this is not a retail necessarily product, right? Individuals were just using Zoom, and using the free version. And of course, that doesn't benefit Zoom, right? In terms of the data they collect, that is positive, but they also want to monetize. And so we're going through a cycle, especially if if we're in a recession, that's only going to accelerate this use of virtual video communication. So companies are kind of going through this rip and replace cycle where, this happened to Cisco, 20 years ago, where they're taking, as there was a shift to cloud. So what we're seeing is that, people are looking at Microsoft Teams, other platforms, and Zoom in a hybrid environment where you have people in person and and joining virtually. Just the technology is much better. I mean, we used Microsoft Teams because it was free, right? And we've completely shifted over to Zoom because of the quality of the calls, certainly externally when talking to clients. It just is a smoother technology because that's all they do. That's what they focus on, right? And so, as companies cut back, a Zoom license is very cheap, right? And so we're starting to see an increase in enterprise usage. That is leading to, we think, the growth potential and taking market share from these other products like Microsoft and Google. Now you can see our entire view, all of our assumptions. We just recently open sourced the Zoom model. So you can go to our website, ark-invest.com, and you can actually download the Zoom model. We have a blog that explains, how we valued it. And you can actually download the model. And for those more tech savvy, financial savvy individuals, you want to actually change some of those assumptions, you can go ahead and play around with that. So that's kind of how we approach kind of the market in the sense of this open research ecosystem. We want to put all that out there because we are we want our critics to pull pick us apart, and there's no better way of doing that than posting your research online for all to see. So we don't sit in a room and just bounce our ideas off of one another. We like to share them with the world. We like to get feedback from those that are building these technologies, even professors, entrepreneurs, even earlier stage venture capital investors, to provide insights and different vantage points on kind of how these technologies and companies are evolving.
Awesome. Thank you so much for your time, Ren. This was just really, really incredible. Usually we do have a Syfe plug at the end, but again, it was so exciting to hear from you that we totally skipped it. I think very informative. Certainly brings back my excitement of investing into disruptive innovation again. And yeah, I look forward to seeing how these technologies and innovations pan out in the future. Thank you so much.
Thank you for having me.
Awesome. Thanks everyone for joining in today. Hope this was useful, and please stay tuned for more of such sessions to come as well.